right. So, first and foremost, one thing you said on the show, what was that, 2 weeks ago, which I thought was very, very prudent, was the idea of inflation is the signal we've been waiting for. Inflation is the sign that things are blowing up and that Bitcoiners are right. So, you want to start there and then we'll just lead the conversation wherever we go.
Yeah, sure. So, on that episode, a lot of stuff that I talked about actually is starting to unfold right now. So it's happening even faster than some of us can really realize. Mostly because it's happening under the hood, right? And then the powers that be, the authorities, their data is not as accurate as it should be. But when you talk about inflation, where you really have to go to is the definition of inflation, because what we're seeing is like two different viewpoints bashing heads, and we don't even have the right words to explain our viewpoints, because the Keynesians, the modern monetary theorists are saying inflation is one thing, and then free market advocates are saying inflation is another thing. So obviously, Yellen came out from Powell's answers the other day. We can tell that they don't think that running a budget deficit causes inflation. They don't think that increasing the currency supply causes inflation. So they've just changed the definition of inflation to a general rise in prices. But that is not the correct definition of inflation. The correct definition of inflation is a general rise in prices because of an increase in the currency supply units that steal their purchasing power from all other currency units. So they're just lopping off the because of what's happening and using a very generalized definition. And the best way to imagine this is to just quickly kind of go through the economics of how this would work. So today we see that the economy is struggling in real terms, right? So GDP without the right CPI GDP deflator is still positive. But when you go back and you look at real CPI and plug that in and have the proper deflator, GDP is stagnant or going down. What do I mean by that? It means the economy is not growing super fast. The economy is not the reason why prices were going up. The cure to higher prices is higher prices. So if the economy was the reason that prices were going up, like the government says it is, well, then that would be a good thing, because as prices go up, producers make more money. And as producers make more money, they increase their supply. And when they increase their supply, they lower their marginal cost of production. The example I used last time is if you can build 1 million water bottles, it's going to be cheaper per water bottle than if you produce 100,000 water bottles. So this process, which is a natural free market process, it's the price discovery mechanism that signals to entrepreneurs who build businesses and create jobs where there's opportunity to make a profit. That's what draws their attention. So profit is a good thing. And those higher prices drive profit, which drives supply, which lowers the marginal cost of production, which eventually allows producers to lower the front end price because they're more concerned about moving more units than they are about at a higher price. So if we were seeing that kind of inflation, then what we would really see is GDP like we've never seen before. GDP would be off the charts because the economy would be so hot. That'd be the reason that all the prices are getting pushed up. But instead, the real reason that the prices are going up is not because of demand from the economy, but from a lack of purchasing power from the dollar. The dollar gets continually diluted, and day after day, it can buy less and less and less. Now, temporarily, there's been an increase in purchasing power because the Federal Reserve has raised interest rates in the most aggressive clip in modern history. So because of this extreme rise in interest rates, there has been a temporary value of purchasing power driven into the dollar, especially against other fiat currencies. But when push comes to shove on a net basis, there's still a lag time to the 40% increase of dollars they've printed as a result of COVID. So this disinflationary wave we've had, this little break that we've had, is solely due to the increase in interest rates, attracting people into the dollar and buying demand into the dollar. But if they really knew that the real rate of inflation was double what the government CPI says, well, maybe they wouldn't be rushing into the dollar as much. So there's all this data, there's all these facts, it's all getting spinned around, and it's simply not true. Another way I like to think of this, and I want to use a different example this show than I did last show, is that there's two sides to every transaction, right? You have the currency, and then you have the actual good or service. So in this case scenario, prices can go up and down based on the currency or based on the good and the service. So let's just take the good and service first, right? So the good and service affects the price through the basic free market price discovery mechanism, which is a supply-demand equilibrium. So if the supply goes up and the demand goes down, the price comes down. If the demand goes up, supply goes down, price goes up, and everything in between there. But it's a free market signal based on the supply-demand equilibrium. So when there was a supply shock after COVID, yes, partially prices were going up because there was a lack of supply against consistent demand. But that's just one side of the currency pairing. Remember, the other side is the actual USD currency. So we have to understand what's being used to trade. If you think about it in really old terms, like they used to use the seashells, right? Well, as more and more people were getting seashells and people started to figure out, well, these things really aren't worth that much, the prices started going up. Well, the prices started going up because more and more people were buying stuff? No, prices started going up because more and more people were using the seashells, and it was revealed that they weren't worth as much. So that's the same thing that's happening right now. More and more currency is being printed. And with the Fed's new program the banking term funding program they just launched, JP Morgan came out today and said it could inject up to $2 trillion into the system. Well, that's not quantitative tightening. That's not reducing the currency supply. That's significantly increasing the currency supply. Remember, they printed about $5 trillion for COVID. This is almost 50% of that. This should be an overall upwards of 10% plus increase in the currency supply. And people are sitting around thinking the prices are going to go down, which is a weird concept. Let me get in the dollar. Let me sit on the sidelines because prices are going to go down. But at the same time, the government is telling me the economy is on fire. So which one is it? It's this hypocrisy that is really starting to reveal that we're in what I call financial COVID, right? During COVID, the data was botched, the narratives were controlled, and in hindsight, we can look back and say, wow, that was some messed up stuff happened. Well, a year from now, we're going to be able to look back in hindsight and say, whoa, some messed up stuff happened, but it's financial COVID, not medical COVID. The data isn't right. It's getting mixed up, and we need to get our definitions right. So that's why it's so important for people to understand inflation is a general rise in prices, but not because of the economy, because of the dilution of the dollar.